Hey everybody, it's Big Mike. Like always, I want to thank you for being here today. And today we've got John from TopStepTrader, and I've asked him to put together a webinar that focuses on discipline and risk. And the reason that I asked these guys to do a webinar is simple. I felt like TopStepTrader was in a pretty unique position with the service that they offer to traders to be able to kind of look over your shoulder and see what the successful traders are doing, with methodology or psychology or risk management or whatever the case may be, and then also look at what the traders that are struggling are doing and take notes and compare, okay? And not just guess, but actually know, because I'm sure they've got a huge amount of statistics and, can really identify these different traits. So I approached them, and that's why they're here today. John's given me a short list of things he's going to touch on in addition to those broad subjects, and they include basically, I just lost it on my screen. Here it is. Trade planning, market state, market participation. He's going to talk briefly about market profile, trade affordability and risk, along with trade management. So a lot of different subjects, kind of a broad discipline and risk webinar. First of all, let me say that the webinar is being recorded, and like always, I will post the recording sometime tomorrow on the forum. You can just keep checking back, click the webinars button from the top of any page, and you'll see it there eventually. Second, as you guys have questions, type them into the box. They will only be visible to myself and to John. You can't see each other's questions. That's just the way our software works. And I'm sure that John will do his absolute best to answer everybody's question. And give me 1 second, guys, and I will be turning things over to John.
Hello, ladies and gentlemen. Thank you for joining me at this webinar. I just want to make sure that, Big Mike, I have the right screen up. I've opened it up. It should say TopStepTrader, where talent meets opportunity, presented by John Hoagland, Senior Scout.
Yeah, we've got audio and we've got the right screen.
Outstanding. All right. Thank you very much for having me here with you today, Big Mike, and thank you, everybody who has taken the time to join us. I think I should probably start with a brief introduction of who I am. My name is John Hoagland. I have over 25 years in the futures industry. I'm talking to you from the trading floor right now. I started where everybody seems to start on the trading floor, as a runner, worked my way up through the ranks, was hired as a proprietary trader for a couple of years, ended up funding my own account, and then when I got married and had kids, some people that I knew, customers, asked me to come up and fill their orders in the S&P 500s. It seemed like maybe a little bit more stable environment to raise a family and a marriage in. So I opted to do that. I was a futures floor broker for about the last 12 years, up until about a year ago. I took a little time off. I had my first trip to a trading floor when I was 6 years old. My dad was at the Board of Trade for 40 years. Mostly in the capacity as Ralston Purina's hedge manager. He was also the head grain analyst for a company called Chicago Grain, which was around a while back. I used to go down there to the trading floor and hang out with my dad when we had school days off, that kind of thing. Ralston Purina was a huge hedger of grains, big manufacturer of cereals, animal feeds. My dad's responsibility was to work the soybean crush spread so that they could get rid of the byproduct to them, which was the soybean oil, and end up with the meal at much cheaper prices. His dad actually started trading cash grains as far back as the Great Depression. He was in Nebraska. He got a job as a rail clerk and developed relationships with grain elevator operators as well as end users of the grains that were coming from that area of the country in Colorado and in Florida. So he would just work in a quarter of a cent or a half a cent a bushel, and that's how he made his living through the Depression and raising up my dad. So I have a long history in this business. It seems to be in my blood, and I can't seem to get away from it. Currently, I've gone from pit trading and filling orders in the S&Ps to trading the S&P mini on screen, and I'm currently a senior trading scout at TopStepTrader. Kind of like a baseball scout, I kind of sit back, watch how guys are doing, look for trading talent to bring up to the big leagues. With the guys that we see that are making consistent money, we bring them up, put them in a live account, give them a shot at making a career of this. So we are scouting, working with literally hundreds, sometimes thousands of traders from all backgrounds and experience levels. Many making the change from pit trade to screen trade, much like I am. This does present particular challenges to pit traders. This company has really given us a great venue to see many of the issues, discipline, personality, many of the issues that all traders deal with to some degree or another. On a very personal level, we work with some of these people very closely. These are things that I see every day. My goal today is to, in some way, help you recognize something that you could be missing or dealing with in your trading. Maybe you've recognized it, maybe you haven't. But my hope is truly that you take something away from this next perhaps hour that helps you. Okay, discipline and risk. Hang on one second. Oh, I never moved my screen there, but that's okay. What are some of the key factors in developing trading discipline? We see the most improvement from the traders in our program from people with these tendencies. They tend to be coachable. They listen to suggestions. They read. They do their own research. They bring that research into the chat room and discuss it with other traders. They are very passionate about what they're doing. They spend a lot of time and effort trying to learn, trying to improve their knowledge, their market knowledge, their knowledge of how auctions work. And it does show in their trading. It does take time, but you can see the ones that are really listening, open to suggestion and coaching. Humility, another big thing. They're humble enough to know that they're not always going to be right and willing to accept it. Humble enough to know that there are people out there that are successful at this that might be able to help them. They are flexible, willing to accept and interpret the market's imperfect information. And I say imperfect because, as we all know, the information that the market is giving us is never perfect. It is always changing. It seems that whenever you get it figured out, the rules change, and we're going to go through some of the very important factors that you need to consider before taking any trade. They tend to be reflective. The traders making improvements in our program are reflective. They keep journals. They think about the trades that they've made. They write down the facts about it. What indicators were they looking at? What was the market state at that time? What kind of participation was happening? What were they feeling inside? What kind of emotions were they experiencing? Were they tired? Were they focused? These are all things that they write in their journals, and they take to bed with them. They think about it, they work on it, and they begin to recognize patterns in some of these feelings, some of these recognitions. Tenacity, can't say enough about that. They never quit. This is a constant learning opportunity. I've been at this for a long time. I'm learning more now than I probably ever have. There's never You've never learned so much that you can just kind of close off and say, okay, I got this. It's always something that you have to continue to learn about, be passionate about, and humble about. You have to keep that humility. You have a great day. You have to just chalk it up and face the next day for what it is. It is a completely different day, and it may end up with a completely different outcome. Each day, each trade is its own entity, and it needs to be treated that way. One trade does not affect the other. The market doesn't care what you're doing. The only thing that's going to affect you from trade to trade is your own mindset. So tenacity, never quit. If this is something you believe you can do, something you believe in, something that you are passionate about, if you quit, you're never going to know. Which leads to the next point is they have a very strong work ethic. They work very hard at improving, at increasing their knowledge and increasing their ability to execute consistently, become consistently profitable and repeatable, and increase their success as traders. Some people don't want to do the work. They think this is an easy way out, which we, if you have some experience at this, you know is not true. Oops, sorry. You have to work very hard at it. This can be trading futures, trading anything can be a wonderful opportunity, but some people never really see it as that great of an opportunity because it looks like work. What I'm saying to you now scares you away from it, then you might be better off if you find something else to do, because this is work every day, all day. It's not easy. It can be fantastic, but it does take work. Could there be a predisposed psychological makeup that makes one person a possible better candidate to be a trader? I don't know. I know the psychological issues that I had when I was learning to trade. I can give you an example of one of them. Maybe it was a work ethic issue. I wasn't afraid of working hard, but on the days that in my early stages of trading, which there weren't many great days, I spent a lot of time learning from the downside. But when I did have a good day, I did have a tendency within the next couple, 3 days to just give it back. I was working with a couple of guys who actually have a book out called The Inner Game of Trading, Bob Capel and Howard Abel. And they pointed out some things that they talk about in their book, and that is the fact that you really have to believe in your mind, soul, heart, and toes that everything that you can take out of the market, you deserve. On the days when things were going well, it all seemed to come too easy, and that seemed to be a problem for me. I didn't believe that I deserved the kind of profits that I could take on a day like that. So over the next few days, I would certainly find ways to give it back. It wasn't until this was pointed out to me and that I really kind of had to form a mantra for myself, you know, this is something I deserve. If I lose money, I'm going to have to go out and make that money to give back to them. Why is it that I don't feel as though I deserve this money? It's not easy to come by. I have been through the ringer so many times in this pit with losses. Why don't I deserve this money? It took me a little while to figure out that this is hard work and I deserve everything I can take out of it. And another reason you deserve everything you can take out of the market is the service you are providing to the marketplace. You are providing liquidity. For every time you take the other side of a trade, there's somebody on the other side of that trade that needs to get out of it. So there is a service you are providing as well. So believe that you deserve every penny you can take out of these markets with all of your being, because it is true. We've probably all experienced some serious losses at some point if we've been in this for any amount of time. We know how much that hurts, and those are the reasons that you really need to believe that you deserve everything you can take out of the market. Stumbling blocks to disciplinary developments in trading. The big three, of course, we've all heard these before: ego, fear, and greed. Greed, for lack of a better word, is not good, Mr. Gecko. Ego, there's no humility in that ego. If you are so sure of yourself that you can't admit you're wrong, you're gonna rack up some pretty big losses at some point. It may work in your favor at some point, but it's been my experience, people that weren't willing to accept the fact that they could be wrong have really run into some serious problems and didn't last very long standing next to anybody in the trading pit. Fear, of course, is going to keep you out of things. Fear is going to, excuse me, fear is going to keep you from taking trades that you probably should. You know, if you are developing a trading plan that you are looking for consistent information from, you are going to have to get rid of the fear and make part of your plan your contingency for if that trade goes against you, you are going to get out of it. We'll talk a little bit more about that shortly. So ego, fear, greed, the big three. If you need to be right all the time, that can be a problem too. The market is always right. The market doesn't care who you are, what your position is, where your stop is. It really doesn't care. Odds are you're going to be right around half the time, unless you're real good. Knowledge, a little knowledge can be a dangerous thing. If you have great market knowledge, you know everything about every treasury, every stock index, every grain contract, and you think that they should be acting the way you expect them to, that's going to be a problem as well. That goes right back to the humility factor. You have to be able to admit you're wrong and that you might not know everything. It's just got to be done. Not doing the work, the work ethic problem. If you're looking for the Holy Grail, it doesn't exist. I would have found it by now. Really, the only thing that is going to get you through this is your tenacity, your humility, and your reflectivity, and your coachability. You really have to be able to listen to what the market is telling you and react accordingly. The market is going to do whatever it wants to do, no matter what you say. I joke sometimes and say it's like my kids. I should have named my kids S&P and crude, because no matter what I want them to do, they usually do what they want. So, again, not doing the work, big problem. Holy Grail does not exist. Extreme emotions can really be a stumbling block for you if you are reacting with extreme emotions in any direction. That emotional control can cause you to do some things that you would not normally do. Emotional control is very important. There's no way you can have a lack of emotions. One of the things that I had to do when I was learning how to trade, and this was in a trading pit, was I would get caught up in the emotion when the market was running in one particular direction. Let's say, for example, the market's been rallying and rallying and rallying, and I'm not in. I would get to a point and I would say, you know, this looks like it's going to go on forever. And by the time I was able to get it bought, I ended up paying the high. So I had to kind of understand that emotion was actually prompting me to do something, and I had to reprogram my brain to understand that emotion was prompting me, to buy it at that point, was telling me now is a good time to trade, but not buy it. I had to turn around and sell it. I had to basically learn how to take that emotion and do the opposite of what I thought it was telling me. And it didn't take too long. It really hurt the first couple of times that I did that, but as I noticed it was starting to work, it became easier and easier. So I was able to recognize that emotion that I was feeling that would have me chasing the tops all the time as a sell signal. So extreme emotions can be dangerous, but emotional control and understanding your emotions are very important. This all lends itself to discipline and risk. Again, is there a predisposed psychological factor for people that might not or might have a harder time learning to trade and trading successfully over time? That's to be seen. We used to stand next to some extremely successful traders, and they would if asked, how did you get like this? What did you do? What's the deal? They couldn't tell me. They worked hard. They were in there from bell to bell. They started trading one lot, scratching one lots, and over time they were scratching 5 lots and then taking profits on 5 lots, and pretty soon they were shooting 50s and 100s. You can't do that. Those are the Wild West days in futures. I don't suggest that anybody sit down at their screen and start swinging things around like that. It's a much tougher game right now. Back in the pit days, we didn't necessarily have to be right. You just had to be offering and bidding. Sometimes you'd even get hit on your bid and offer at the same time. There were those that developed a great market sense like that, like the example I just gave, but he really couldn't tell you how he developed it. He just worked it, and it became intuitive for him. It's possible for that to happen on the screen as well. You're going to see these scenarios. You're going to see setups that work sometimes, don't work sometimes. You're going to be much more intuitive. You can become much more intuitive on how to handle all these situations if you execute consistently and review consistently. We're going to talk more about that. More stumbling blocks to disciplinary developments in trading. Overtrading. We see it in the program all the time. Risk is part of trading. These are definitely risk increasers. If you are trading every impulse without signal, without verification, you feel like, and I've heard this quote before, you can't make money if you're not in the market. Well, you can't lose money if you're not in the market as well. Not taking a trade is a trade. Overtrading, you're excited, you got your hand on the mouse. Look how easy this is. I just bought one, I just sold one, I just bought some more. You end up just trading too much, generating too much commissions, and in my experience, although I've only been on screen for a little over a year, trading less has definitely paid off for me. I'm much more choosy in my spots and my trades and the things that I have to look for the market to align with my plan. And I only act at those plans. If I have an impulse and no signal, I can't take the trade. I can't, because it's just risk, and it's not calculated enough for me, and I have no way to consistently review those trades that I'm making on impulse. So I just don't do it. I have to pry my hand off the mouse sometimes, but I just can't do it. Another increaser of risk, overcomplication. Looking at 17 indicators and 14 charts for each market that you think you want to trade is just way too much information, and you just can't process the whole thing. We have a saying around here. It's called KISS. Keep it simple, stupid. We can talk about how anybody wants to set up, look at their setups, any tools that they're using. I use, for the most part, 2. A half-hour chart and market profile. And the half-hour chart, I have simple moving averages on those. That's how I base the vast majority of my trading decisions. Any more than that, I can't. I get too many conflicting signals. I get confused, and I can't pull the trigger on anything. Another way that you can limit risk is if you are trading too many markets. Having positions in too many markets at once, for me, does the same thing. It confuses, frightens me. Maybe I'm a bit of a caveman, but I just can't do it. I do look at other markets for correlations in the trades that I'm making. I do occasionally trade. I pretty much exclusively trade the E-mini S&P. Occasionally, when I see something good, I'll jump into the crude, which I'm glad I did not do today, because I don't know what would have happened, but there was some fun going on in there with that rumor that came out that was later denied about opening up the U.S. reserves. So, too many markets, big risk factor. Big problem with discipline too. There's a lot of people, we see it in our program all the time, that think that they want to trade 10 markets at once. And on the floor, I haven't really seen anybody be successful at that, and I'd be surprised if I'm going to see anybody be successful doing that anytime soon on screen. The next point is to hell with it-itis. Capitulation. You've made 8 trades, they've all been losers, and you just want to look at your computer, throw your mouse through the screen and say, to hell with it. And you let the position go. This is the blowing up account syndrome. This is the I give up and I don't care anymore syndrome. It's of course, huge risk. Doesn't do anybody any good. And then it leads you to trading in anger and spite. You know, if you think you're going to get that market because it's been taking your money away, it's probably going to take more because it doesn't care. You need to make wise market-based decisions. That is how you are going to limit risk and build confidence and discipline. With all that information coming at you, how can you process it all? I've seen all these issues in my trading at one time or another. I think we all see it in our trading. We see it in all experience levels at TST in our program, and I'm sure that most of you are kind of looking around if you've never thought of any of these things before, and I'm sure that we've heard of most of them. You're seeing some of these things in yourself as well. Okay, key disciplines being developed, hopefully, by all traders, but definitely at the traders at TST that are willing to do the work. One of the most important steps to limiting risk and trading with discipline is to put together a pretty concrete plan. It's very difficult to remove all abstractions from any trading plan, but the more you can remove, the better off you're going to be if you are going to be reviewing your trading at the end of the day. If you have consistent execution, if you have consistent trade management, then you will have consistent information to really be able to tell yourself how you are doing and where you may need to work on things. One of the important steps to every trade, I like to look at it as the first step. I like to know what kind of participation, what kind of state the market is in. Is it a trending market? Is it an oscillating or chop or consolidating market? Or is it a market in transition? Who is in control of that market? And how do I get with them? If you've got fundamentals buying, you've got a market that's been trending higher for some time, and it looks like it's going to keep going. How do you get in on a market like that? Well, you're probably not going to be trying to pick tops. If you're in a trending market, you're looking at one-sided trade. You're looking at playing the buy side if you're trending higher. You're going to wait for the market to come back to a level of support, and you're going to try to get into that trending market at that time. If you're in an oscillating, consolidating market, two-sided trade is perfectly acceptable. If you are in a bracketed trade, if you're in a market that is kind of just rotating back and forth between two or maybe several known areas of support and resistance, as it gets to the high, you want to try short positions. It's good trade location. You don't have to pay a lot if you're wrong, and you have good probability of having a trade move in your way with price action. One of the important things about market state identification is that you recognize the different market states. We see traders every day who are great at trading one type of market state, but they struggle badly in other market states. Great trend traders, but if the market gets into a consolidation or an oscillation or a chop, they don't know what to do. They're buying the highs because they're always looking for the breakout and selling the lows. And they don't seem to understand that you have to wait for some sort of a verification, probably with volume and price action, that breakout is happening. Then you're looking at a transitioning market. There's I don't know how many tools for recognizing market state charts, market profile, moving averages, exponential moving averages, ADX. The Arun oscillator, which is really a tool to try and help place trailing stops, but it's something that I've been watching. I don't use it to trade, but I find it interesting that it usually does indicate some sort of a turnaround. Whatever you find works for you. There's so many different tools. I find it very difficult to suggest using any particular one. It's not really my place to talk to you about that. I can tell you what I use for me to recognize market state. It's a half-an-hour chart, market profile, and simple moving averages, 50, 100, 200 session moving average. I like to keep it simple. KISS. Keep it simple, stupid. The point is identifying market state and having a plan for each market state gives you the confidence and discipline to take the necessary risks in order to get the profits you are looking for. Some traders don't trade certain markets well. Perhaps that should be in their plan. If they are if they're identifying a market state that they don't trade well, perhaps staying out is the best thing that they can do. Next key discipline being developed by traders everywhere, recognition of market participation. The market's job is to facilitate trade. We all know that. The market is always going to seek out where the easiest two-sided trade can occur. If the perception of value, the collective perception of value, is changing, then the market participation is going to change. The price discovery is going to move the market to wherever the perception of value is. I think most traders miss the importance of market participation, particularly in the beginning of their trading careers, and the effect that market participation has on the information being provided by the market. If you don't mind, I'd like to talk a little bit about the difference between the day session and night sessions right now. This isn't true in all markets, but in my opinion, I think that the information coming from the day session, even in the electronic market, but in the S&Ps from 8:30 to 3:15, the vast amount of most of the risk transfer in that contract comes between those hours, even in the electronic contract. So that would suffice to say that most of your fundamental players are playing during that time. Sure, they're probably looking at it at night. Sure, you're going to have some overseas interest in the S&P 500 overnight as the Asian markets open, as the European markets, but the vast majority of the information and trade that comes from the S&Ps is during the day session. That to me is much more powerful information than the things that happen at night. At night, I like to see when something I was expecting to finish during the day and it didn't. Sometimes it'll finish at night. Again, I think that the information that comes from the day session, particularly in the S&Ps and in the other U.S. indexes, your cash, your tangible commodities, your meats, your grains, your interest rate markets, your treasuries, your euro dollar, I think all the most powerful information is coming from that time. Okay, back to the market's job to facilitate trade. The last trade price represents the collective perception of value at that specific time. It is where all the players, buyer and seller, see the fairest price at that very moment. As participation falls, the market will seek new levels to try and bring new participants into the market. If the perception of value changes, like it did when the announcement came in the crude today that the U.S. was going to release crude from the U.S. reserves, the perception of value of crude dropped. The buyers dried up. The sellers had to push the market to a point where buyers were willing to take the other sides of those trades again. As the rumor was denied, buyers ended up in the opposite situation. Selling dried up. The buyers had to bid the market back up to where two-sided trade could occur, where the volume is. Initiative participation, players initiating trades due to changing information in the marketplace, packs the highest conviction. You have initiative participation, you have responsive participation. Initiative participation is really when a possible change in perception of value is occurring. You have fundamental players, people who really move the markets, interested in either buying or selling a particular instrument or commodity. They are initiating trades. Responsive participation is traders just responding to higher or lower prices created by the initiative participation. It doesn't hold the same conviction as the initiative participation. Identifying initiative versus responsive participation can be very key to finding out who is in control of the market. It leads me to fundamental versus technical traders. Although fundamental traders may look at technical indicators, they're the ones who really move the markets. They're the producers and the users in physical commodities, and they are the market force that speculators and technical traders should be trying to decode and side with. They are the ones who really move the markets. All the small-time speculators in these markets don't really push the market around like your fundamental traders do. Your technical traders, your algos, none of them do. So the big question remains, what direction is the market trying to go, and how good of a job is it doing getting there? The answer is always to the volume. Volume is the key because the market will always trade to where two-sided trade can occur. If you can look at market state, volume, initiative and responsive trade, and market participation, they all hold the answer to directional conviction. The best tool I know for this kind of study is market profile. That's just for me. There are plenty of other tools that you may be using that are working for me. So market participation / price discovery, extremely important. So we've taken a look at market state, siding with who is in control of the market, and market participation. Who are the players involved at that time? And are they initiating? Are they responsive? All very important information that can help you limit risk and very important disciplines to develop. The importance of trade location. Trade location is highly important. When you are looking to execute a trade, you must consider where the trade location is, the day type, the market state, the trade location in relation to the day's range or previous ranges. You have to watch the extremes, the ends of the ranges. If you are looking at a market that is trading near its extreme for the day, it's either going to fade, it's either going to turn around and head back and rotate back lower like markets do, or it's going to break out. If it has the volume and legs to extend the range, then it's going to break out. You have to trade against known or assumed areas of support and resistance. There has to be signals that are telling you to take these trades, and not impulse, not emotion, not anger. I like to make sure that when I take a trade, I have relating signals telling me to do the same thing from two separate studies. When I have a high of value and a moving average right in that same area, that's an area that I'm going to consider either support or resistance, and an area I'm probably going to take a trade. For one reason, it's good trade location. Some of the cheapest trades in my experience are signaled by market profile. I found it an invaluable tool for identifying market state and good trade location. There's different day types that it identifies. If you have an inside day, a non-trend day, a trend day, a double distribution trend day, there's all these different structures to profile that you can start to identify and even start to predict. You know, if you take the chance, if you're early in the day and the profile structure hasn't really been created yet, but you're noticing things that can give you some early detection of who's in control of the market that day, you end up with good trade location. It's a great tool because of the value areas, point of control, very valid points of support, resistance. What was support becomes resistance. Auction acceptance and failure, it really does a good job of pointing out directional conviction, initiative and responsive participation, and to me it's a key to detecting your fundamental, your other time frame activity. I do have a couple of profiles from the last couple of days here that maybe I'll drag into the screen here and we can take a quick look at. Hopefully you can see this pretty well, but this blue line over here is the initial balance. That's the first hour of trade. That's the range of the first hour of trade in the S&Ps yesterday. This gold bar right here is the opening range. We had a market that opened and ranged for the first hour in here. After the first hour, the range was extended below the initial balance, which is the first indication that the sellers may be in control during that day. Another indication it is extended again and extended again and extended again. I understand it's too late by that time to figure out what we're going to do with that, but you've got the value area here in green. The value area is where 70% of the trade for that day has occurred, or that session to that point has occurred, leaving 15% of the trade above, 15% of the trade below. You were offered a couple of opportunities after this D bracket tipped past the initial balance to short. Once here, these yellows, and once here, these greens. Two opportunities to sell above value, which ended up in profits. You know, my first objective for these trades would probably be the low of value. So if I was able to short the high of value or above value, let's call it 91 halves, the high of value. When the market got back down to the low of value, 86 half. So we're looking at a nice tidy little profit there in the S&Ps. These are some of the things I look at. So this little red tail up here, this is a failed auction, also called a selling tail. It would be responsive selling. It's the high of the range. Initiative buying brought it up there, but this auction failed. This would be another failed auction at the bottom here, but the other way. This would be initiative buying due to its relationship to the previous day's range. So this initiative buying up here was met with stronger responsive selling that took the market down. Just one example of how market profile can provide you with some pretty cheap ideas and some pretty good trade location on some trades. By cheap, I mean if I'm shorting 91 halves, the minute it starts taking these single ticks out up here, I'm going to start getting a little nervous. So I may risk a couple of bucks to make 5. Not bad risk reward. That's why these value areas and market profile are so important to me. This would be basically a ranging market, almost a little bit of a trend day lower. The day before, a trend day higher. The initial balance again, the blue, the opening range right here. Now, when this profile was developing, I was telling people in our program, be careful being long until we penetrate the high of the initial balance and the high of the opening range here. I said if we get past here, if this initial balance tips to the upside, watch out, you do not want to be short. Throughout the rest of the day, we had a market that trended, pretty much a double distribution trend day, and finished the day quite strong. Which kind of why maybe the next day we just kind of ranged there. So hopefully you're finding this to be useful information. Just a quick example of how market profile helps me. So we've looked at the importance of trade location. Next we're going to look at, if we can get this to move, trade affordability. Trade affordability is extremely key, especially in the development of a trading plan. And if you are, we should all have a loss limit to trade throughout the day, to get good reviewable information, to get good confidence building, to get good risk management, to get good trade management. We all have to have a loss limit, because you want to be able to play the next day. Loss limits save you from the hell with it-itis and blowing up the account. If you have a loss limit, there's a couple things that you need to think about. In our program at TST, this seems to be one of the biggest issues with your newer traders. They like to hang on to their first trade like it was a present, and if it goes against them, they want to hold on to it until it comes back, and it never works. We'll talk a little bit more about that in a little bit. They also like to trade huge. They like to trade this big size. If you hit your loss limit of 1 or 2 trades, it really helps nobody. It's too much risk. Doesn't give you the time to get probability and math on your side and take the trades that are going to actually pay you, not the ones that you have to pay for. Losses are information from the market that you are paying for, but it can be very valuable information. You know, if you get a couple 3 losers in a row, depending on your conviction and how you feel about it, that information might be telling you something. Perhaps you're sided the wrong way. Perhaps the market is not in alignment with your plan yet. But it is information, and it's important to keep it cheap. The less money you can lose or pay for that information, the better your chances of being a plus player at the end of the day. Try and keep those losses small. If the market is telling you you are wrong, get out. You don't have to get in right away. Take a walk, think about it, wait till you come up with another good setup, and stay disciplined and always consider your risk. You have to accept those losses. Every trader, the best traders in the world, have losses every day for the most part. And again, those losses are valuable information. If you find yourself wishing the market back, it will only cause bigger losses, and if it ever works, it just reinforces bad habits. We call it hopium. When you have a bad position on and you're hoping the market comes back, you take some hopium and it makes you all warm and feel all warm and fuzzy, but it won't last, and it is definitely a big risk increaser. I think one important thing that traders should know is, how many consecutive losses have you taken? If you're a guy that's only taken 5 or 6 consecutive losses before your first winning trade, it's something you need to know. Your size should be adjusted, especially when you first start trading for the day, so that you can withstand your maximum number of consecutive losses and still stay in the game. Staying in the game allows you to trade through the whole day, and it gives you the best opportunity to have very good, consistent, reliable information for your review, as well as better probability to end the day in the positive. Of course, that's true. If you hit your loss limit and you can't play anymore, you have no chance of ending the day positive. I'm telling you all this because I do see it every day. We have a lot of very good, very smart people in our program. I have deep feelings for all of them. I want them all to succeed. And I know how tough this road is, and I hope that they can. I hope everybody is doing the work, and I really would like to see that everybody succeed. Trade management, the next key hurdle and very important thing for risk and discipline. Trade management is kind of self-management. Your trade management needs to be logical and reasonable for market state and the trading time frame. It should be part of your plan as far as volatility is concerned. Market state, what direction is it heading? Is it heading a direction? Stop management, also very key. Your stops, just like your entries, should be placed at logical points where the market is telling you you are wrong. Trailing your stops is a particular challenge, but it's something I do suggest to limit risk and eventually protect profits as the market moves your way and indicators may fall off or validate your position. Depending on time frame, profit objectives and stops can be dynamic and relate directly to market state. There's risk reward to consider. Keeping the math on your side. If you are right half the time on half your trades, but your win-loss ratio holds at 2 to 1, over time, it makes you a plus player. You don't have to be right more than 50% of the time. If you're making twice on your winning trades, then you are losing on your losing trades. That's actually a pretty good trader. If you're only right 20% of the time, you need a 5 to 1 risk reward ratio to break even, and that's before costs. So if you can't have a better risk reward ratio, eventually you're going to bleed out the account. Many platforms have trade stats that you can look at. I look at them all the time. They can point out these patterns to your trading. If you're not looking, if your platform doesn't have one, these are statistics that we look at every day that you should be taking into consideration in your trading. So we've got basically 4 things that we're looking at to help you develop discipline and limit risk. market state identification, market participation, trade location, execution, and trade management. There are so many parallels to trading successfully in sports. If you consider, I'm sure there's some golfers out there, consider your golf game. Before you swing the club, there's a few things you even have to consider, just like before you take a trade. In golf, perhaps it's the grip, stance, ball position, and posture. You got to get set up to swing the club right. In trading, it's the same thing, except instead of grip, stance, ball position, and posture, it's market state, market condition, market participation, and support and resistance. So now we've got the mouse in our hand and we're ready to swing the club. We swing the club, we take the trade. This trade happens to be good. So does the golf swing. We hit it right down the fairway. Now it becomes trade management. The choices that you have to make to manage that trade. Are you seeing your indicators fall off, or are you seeing verification in your trade? Should you be adding to the trade? You're walking down the fairway, you get to the ball, you found it's landed on an acorn. How are you going to deal with that? That's something that you have to manage. It's the same thing in baseball. You've got the grip, you've got the pitch, everything lining up. Sometimes you're going to hit it, sometimes you're not. You got to be able to move on. And each trade you take is like a hole in golf. You got to line it up. You've got to hit it. You got to manage that hole. Sometimes you're going to get an eagle. Not many for me. I'm not that good a golfer. Sometimes you're going to get a birdie. Mostly pars, bogeys, and double bogeys for me. But still, you don't have to be an expert to enjoy the game. Your top traders perform at top level all the time. Your top golfers perform at top level all the time. But there's plenty of people who enjoy the game of golf and are very successful at it that are never going to be on the PGA Tour. You don't have to be a top trader to make a great living as a trader. You do, however, have to have discipline. You do, however, have to limit your risk. And you do have to, however, have a plan for that. Okay, I want everybody to just take a second. Keep in mind that nothing works all the time. All these indicators, they all come from past information. Today's traders really do face obstacles that didn't exist 10 years ago. The market has become so efficient. There are traders in algos that sense order flow and seek to take out smaller, shorter time frame traders. So it's important not to get up in what I've heard people call, or in what I call lemming trades. As you trade, be thinking about what the other traders will be thinking, and try not to get caught in the crowd, because the crowd usually gets taken out. We have one of the most important parts. We feel one of the most important parts of becoming a disciplined trader and limiting risk is the trading plan. Having a trading plan with as few abstractions as possible, detailed in setups and trade management, can give you the confidence to enter the market and know you will do the right thing. Every trade's not going to be a winner or a loser, but you have to have the confidence to know that you're going to do the right thing. When the market's telling you you're right, you do the right thing. The market's telling you you're wrong, you're not taking hopium, you're doing the right thing. Trading your plan consistently will give you the best information to review your trading and make changes to increase your probabilities of earning over time. This takes the kind of time and effort that some are unwilling to commit to. In the long run, doing this hard work may turn out to be the only shortcut there is. It can save you time and a whole lot of money. That's, to me, the holy grail. Just do the work. If you can front end all the work, you save yourself a lot of time and money. In the end, if you are disciplined and create a plan that you can execute consistently, that is profitable and repeatable over time, then it's time to add volume to increase profit. As senior scout, I've seen thousands of traders. We are working to discover, develop, and fund traders who are willing to do the work, limit risk, develop the plan, and show us what they can do. For TSTers that are with us at the webinar today, the secret word is Sweet Melissa. So, ladies and gentlemen, I think that's about all I have for you right now. If you would like to ask some questions, I'd be more than happy to answer if anybody's still there or awake.
Hey, John. Yeah, there's a bunch of questions, and I'm sure we're going to start getting more right now. So first, really fantastic presentation. Great.
Thank you very much.
Okay, so let me go back and find the first question, and I invite everyone to start typing in their questions, and we'll get to as many as we can. Okay, David wants to know, he says that most of his trades are profitable, but on the whole, he loses big. He likes to hold his losers, but cut his winners short. He almost always finds himself with 3 times as many contracts on losers than winners. And he wants to know what he should do to change that behavior.
Okay, that brings me back to something my dad said when I first started trading. He said, son, when the market's going your way, you're never going to have enough on, and when it's going against you, you're always going to have too many. David, I'm not sure what your time frame is. If you are just developing a plan and trading on simulator, or if you're playing in a real account, the first thing I can suggest to you is stop trading anything more than one. Figure out, let me think about this. Start at the beginning. Start trading ones. Take a look at your tools. Do the research. If your tools aren't giving you the information you need, you might want to look at something else. Cutting winners and letting losers run is the exact opposite of what you need to be doing. And so much about trading is contrary to human nature. When the market is giving you money, your first instinct is to take it. When the market is taking money away from you, you don't want it to. You don't want to take that loser. You don't want to admit the loss. You don't want to take the loss, so you clam up and you sit there and think you're going to wait for the market to come back and make you whole again, or even make you money again. I see it all the time. I've been seeing it for years. They used to call it, I don't want to use any foul language, but they used to call it eating like a bird and pooping like an elephant. You got to try and turn that around. Don't let, when you have a position, you take a position that goes your way, at some point you've got to protect that profit, or at least limit the risk on the trade. If things turn around, if your price action is going your way and things turn around, you can't move your stop. That's the first thing. You keep your stop where it was. You know, in the trades you're taking, you have to try and have a little better than 1-to-1 risk-reward ratio, unless you can count on being right 60-70% of the time. Maybe you can. But the first thing is, stop eating like a bird and pooping like an elephant. If you are eating like a bird, you got to poop like a bird. Once you get a little bit more familiar, and I don't know what your experience level is, once you get a little bit more familiar with the experience of having a trade go your way and realizing you're right, give those trades a chance. Don't, you know, if you have a profit objective, try and let the market get to that profit objective. Begin to protect profit by moving your stop. First thing you're going to do is move your stop to break even or +1. If again, depending on your time frame and your risk reward. If you're risking $2 to make $4, then you've got to give the market a chance to get there. There's also a little bit of market state involved in that. If your profit objectives aren't reasonable for market state, you're going to run into that problem more and more. So just try and keep in mind, you can't eat like a bird and poop like an elephant.
And I'll add my 2 cents real quick, and then we'll go to the next question. When someone asks me this, I typically find, first of all, I ask them, do they have a trading journal? And if they don't, well, then that's mistake 1. But if they do, hopefully, I'd like to see what is different about the trades that they're hanging on to the losers. And when I say trading journals, I don't mean a spreadsheet that lists entry and exit points. I'm talking about a why did you get into this trade and why did you exit, you know, the trade type of a journal. And what I typically find is the people that hang on to losers, it's because of fear and because they don't have a good trading plan. So they don't really know when they're supposed to exit. and they avoid exiting to avoid feeling that pain, because once you exit, it's done, right? It's final. You've taken the loss. It can't come back. It's over. And then you get out of the winners too quickly for the exact same reason. It's because you don't have a plan. You don't know, you don't have any confidence in the ability to hold the trade to the target, because your plan hasn't convinced you for whatever reason that that is something that can actually happen. So anyway, that's my advice. Okay, next question.
Outstanding.
Next question. Rose wants to know, why are you guys, do you guys use Cunningham T4?
Yes, we do.
Okay, and
it is.
Go ahead.
It is one of the. It's one of the most popular on the trading floor. That is where we all work. That is where we all trade in office. It is one of the more stripped down, but it is a very quick connection to the exchange. Floor traders, I guess, tend not to want any automation, bells and whistles, or distractions. That's one of the reasons we use it. Our primary clearing firm is also Cunningham, which is CTS, and I walk around the floor from time to time, and I see absolutely no retail front end presence on the trading floor. It's either TT or T4.
Right, and I've always heard good things about T4. Usually the people that don't like T4 are the ones that have 20 or 30 indicators on their chart. All right.
Yeah.
Boyd would like to know, he says it's BDES, BDEZ. How long does it take for you to determine the market state in the morning in order to make your first trade?
I think I know who this gentleman is. It's BDEZonia, and how long does it take? Some days it takes a long time. Some days there are better indicators than others. Like in the E-minis, I like to keep a very close eye on the opening range, especially when it is at the extreme of the initial balance. So if the opening range is left at the dead high or the dead low, that's one of the first things I look at. It can be the first indication of a day that may trend in that direction all day, because right from the opening bells, one of the other time frame players has taken control. Now that control can of course change and turn around at any day, at any minute, like it did 2 days ago in the S&Ps. The opening range was the high of the initial balance. The initial balance finished. It actually tipped past the opening range, made a new high. That was my first indication that I was telling people in the class that we have at TopStepTrader every day. If this initial balance gets tipped to the upside, don't be short. And that was the day we had that the nice big trend day all day, and it just kept going. It just would not stop. So the initial control that was exhibited, that opening drive to the downside, which left the opening range at the dead high of the day, once that tipped, that gave me an idea that that initial selling that had taken control first thing in the morning, by the start of the second hour of trading, that force was no longer present in the market, and that I did not want to be short anymore.
Okay.
So that was an early indication for me. Some days it takes me a lot longer to figure out what I want to do. I'm notoriously not a good morning trader. I usually am waiting for some sort of structure to appear a little bit in the profile before I start really taking trades.
Okay, going back just very quickly, David had a follow-up to his first question. The guy that says his winners are bigger than his losers are bigger than his winners. He says that he has developed a very profitable and sound trading system, but he continues to cut his winnings short. I know that you've already given a long answer, so I'll just real quickly say his journal, I think, is what I would focus on personally, is take a step back and try to figure out why you're not following your trading plan. It could be that you're not comfortable, right? You're trading too big. You don't have confidence. You've not forward tested it enough. You know, it's going to be one of those areas, and that's why you're not following it.
Perhaps a little emotional control.
Yeah. All right. So Sal says, how do you determine or distinguish who is in control of the market, like algorithms, technical, or fundamental players?
I don't consider algos ever in control of the market. I think the force that they inflict on the market is in very small ways, and that the market eventually does find its true value. Um, uh, there's there are things in the body of the profile that can tell you. Here, I'm going to. I don't have a good example handy. This might be. Hang on one second. Well, this would be more for tomorrow's trade. Each of these little boxes in the profile, or letters as the case may be, depending on your program or how you look at profile, is called a TPO. It's a time price opportunity. It is a time that you have an opportunity to take a trade at a given price. As these TPOs stack up, one of the features of the profile is called the point of control. The point of control is the widest area of the profile closest to the center. So if the center were here, well, there's only one widest point, and that's right here. Okay, so if the point of control is 95.5, you have all these TPOs stacked up under here. If you were to count the TPOs below the point of control, don't include the single tick buying tail at the bottom, and then if you were to count all the TPOs above the point of control, you'd come up with a ratio. And I would venture to say, by looking at this, the bottom number is probably going to be twice what the top number is. That is an indication, and the fact that the high of this, the height of this point of control is so much higher than the center of the range. It's an indication that buyers were in control of this market and were in control of this market for the most of the better part of the day. Who knows if this is going to continue? The volume profile looks like it's even higher than that. This looks like it was the highest volume price of the day, and this is the price that the market traded to the most. This is actually considered the fairest price in this profile for the buyers and sellers today. It's pretty high. There's a lot of TPOs below it. I would venture to say that if there is a battle going on between buyer and seller, that the buyer is winning this war through this profile, and it kind of runs with the way the trade has been. I mean, we've had some since the beginning of the year, really. I mean, we've just been trending higher, trending higher, trending higher, and it just continues to fit. So that is one way that you can establish who's in control, buyers, sellers. The other way, again, is an earlier way is once you get this initial balance, you have that first hour of trade. Once it tips to one direction or another, that can be a powerful indicator. Now, again, nothing works every time, but this is a cheap trade. If you get this tip up here, you look to buy a pullback, maybe back to the point of control when the point of control was right here. You get the market pulling back to this point, which it did at some point before it continued to extend that range. In this little yellow bracket right here, it traded back to down here, gave you a chance to buy point of control and opening range, and that's when it continued higher. So okay. There's a few ways to distinguish who's in control there.
Okay, and John, just so you know, we've got over 100 questions right now.
Oh my God!
Yeah, just so you can have a little perspective. All right, Paul would like to know, can you share more on the rotational factor and how you use it to make trading decisions? And then I would like to tack on my own question to the end of that and ask you about where you believe stops should be set, and do you consider the rotational factor in setting your stops, or do you use swing high-low for stops?
Okay, rotation factor. We're going to put the splits into this chart. They actually list rotation factor. If you can see it up here, it's a RF26. I don't know how they come up with that number, but there's definitely a positive rotation factor to this profile. And what that is you take this first bar, the next bar has a higher low and a higher high. Well, you give it a +1 for each of those. If it's a higher high and a higher low, it gets +1 for each. You got +2. This one, now we're at +4. Now we're back at +2, +4, +6, +8, +6, +4, even, plus 6, even, even. I see a plus 6. I don't really consider rotation factor for stop placement, but I do consider rotation factor for market state.
Okay, so that was my bad. I always thought I assumed that
Oh no.
rotation factor was talking about kind of the well, a lot of people call it chop.
Okay, no, maybe I misunderstood the question. If we're in chop, then all I do in chop, I don't trade the middle of the range. If this, like, let's say this, if you could call this chop, I mean, there was no real direction in this trade, although it did trend a little bit lower. But some days you'll have a really wide initial balance, and you'll have a day that just kind of rotates back and forth between the high and low of the initial balance and the high and low of value. That I would consider a consolidation, even if it's a short-term, one-day deal. That I would look like as a two-sided possible trade market until it takes out these tails at either end. So if I'm going to be trading in a market like that, I'm going to be taking longs at or below value and taking shorts at or above value, because if I can get long here, I got, what, 6, 8, 10 ticks before I know, okay, something might be wrong. We're leaving this balance, and I need to consider getting out of this position. It may turn around and go right back into balance and trade back up, but if that's the case, I know how to react to that. What is going to tell me not to take this trade when I get below value? If I'm thinking about taking it long, it's going to be price action and participation. If I notice volume picking up, if I see price moving, if I'm looking at my my market history, which is time and sales, and I'm seeing a lot of size trade on the bid side, and that size seems to be picking up and volume seems to be picking up the closer we get to the end of this range, I might not take that long position, I might not take that long position, because it's the participation that's the key to me. If the market comes down here, price action slows, volume kind of drops off, and it just kind of hangs here for a little while and nothing really happens, well, it's not finding the volume that it's looking for, so it's going to go back to where it found the volume before. It's going to test that fairest price that it had, that it's seen so much today. It might even come back up here, and if I'm seeing volume pick up in this area, I might not take a short position. I may have to wait and see if this thing is going to break out. If I'm seeing a lot of volume and I'm seeing a lot of price action, watching the time and sales, or watching my dome and seeing a lot of action occur up there, I might consider not taking that short position and seeing if this thing is going to break out. If it does break out, I'll try and find some sort of average retracement to get on to get into a long position, even though it's rotten trade location in this time frame, in this profile. If we are going to move to another balance, it's going to be great trade location if this market were to rally and then form another balance up here. It's great trade location for this balance if that is what's going to occur. If I do take a long position, it gets up here, runs out of gas, kind of returns to the range, maybe even to value, then I know, this thing didn't have the legs I thought it did, and I need to get out of it and take another look at it. But either way, they're cheap trades. It's not like being short here and going and then having it still when the market's trading up here and then facing a breakout. You got a big problem on your hands.
Okay, before I go to the next question, I actually had one more question myself. So you said that you use T4. Explain to me, if someone joins your program, you give them T4, I assume.
Right.
Do they need to use T4, or can they use their own charting software?
Well, no, they can use their own charting software. The only thing that we need them to use as far as the T4 is concerned is the dome.
Okay.
Because if you go through any other front end, we're not going to be able to see the trades and get the information that we need out of it.
Okay, so they could chart and then just use your dome. So
yeah, absolutely.
Obviously, you're a big believer in market profile, which leads me to my next question. Does your T4 come with market profile charts or TPO charts?
We have the program does not currently sustain that. When you join TopStepTrader and you get your account for the first time, they give you the market profile for the first 2 weeks. After that, they pull it away from you. It's kind of an expensive feed. We have not added it to the program in an effort to try and keep costs down for everybody in the program. I do, however, teach it in a class that I put on it for an hour a day every day, and I do suggest, even if you have a program that has market profile, get some graph paper, learn to keep the charts by hand. I did it in the pit for years, and I truly believe that it kept me a lot closer to the price action and a lot closer to and a lot closer to the profile, and taught me a lot better how to read it and how to feel it and how to look at it.
Okay. But I mean, if someone's a profile trader, they can just bring their own charting app to your...
Yeah, absolutely. All you really need, the information is right in your half-hour chart if you did want to do it by hand.
So that's actually a perfect segue to the next question. Paul wants to know, why do you use 1 hour instead of 30 minutes for the initial balance?
That is the rule that I've always been told. When I was a pit trader and I got shoved into the S&P pit, and they said go figure it out, and I was getting my butt kicked because I didn't know market profile. I hadn't thought to use it. Pete Stottlemyre is actually a Board of Trade member that is an acquaintance of my dad's. My dad was friends. Is friends. Well, I mean, they're not friends. They're both still alive, but they don't know each other anymore. My dad retired 20-some years ago, but he's still around, thank God. But I remember being in high school and him saying, hey, there's a guy at the Board of Trade who's coming up with this new way to look at markets. And so he's showing me all these letters and everything. It really didn't mean anything to me. And as I got into my career at the Merc, you know, it just kind of went by the wayside. But one day after a tough day in the pit, a friend of mine grabbed me and said, here, take this book home, read the first 100 pages, bring it back to me, and get your own copy. It was Mind Over Markets, which is a market profile-based book, but by a couple of guys named Dalton. In that first 100 pages, I learned more about the auction process than I think I had up to that point in my career. And according to the, I believe, original text written by Pete Stottlemyre, as well as this book, the initial balance is the first hour of trade in any market, and sometimes a little bit longer in the S&P. If the S&P is making new highs or new lows as that 9:30 hour strikes, you add that to where that new high or that new low would be to the initial balance. But as far as I understand, with the original text, that is the rule.
Okay, Sharon would like to know, what is the yellow bar on top of the blue initial balance?
That is the opening range. I'm not quite sure how it is calculated on the electronic in the electronic markets, but in the trading pit, it is it's technically it is the price range it takes for all the orders that are in the pit before the open that are due fills on the open. So the opening bell hits, everybody gets their opening orders done, then the pit committee asks all the brokers, where did you trade, where did you trade, where did you trade, and they come up with a range of where the prices had to move to fill all those orders. And I'm sure on the platform it's a time thing.
Okay. Ian wants to know, for traders who exercised all the traits that you outlined at the beginning, humility, hard work, tenacity, open-mindedness, etc., and have traded the ES for the last 5 years, how many profit points per contract that is not measured by number of contracts traded would they consistently earn week after week? That's okay. That's a loaded question, but I'd like to hear your answer.
Okay. Well, I'm not even sure that I can answer it. You know, we haven't talked about time frame. We haven't talked about indicators. We haven't talked. I mean, I'm not even sure.
Yeah.
I'm not quite sure how to answer the question.
42. Okay.
Right.
Let's see. We've already answered a lot of these. I'm just trying to find the next one. Okay. Ruben says, thanks for the excellent presentation. I always wondered how professional traders evaluate the activities and the criteria of the combine. Has been a revelation. I'm doing simulated 4-week combine on my own right now, and I've just been learning to trade with the parameters that the combine sets. Trying to skip to see if there's a question in here.
I'm glad that you're with us. I'm hoping that this is a great learning experience, if nothing else, for you. The combine parameters are set to try and expose some of the weaknesses that you might have, to point them out, to know that there's something that you need to work on. And like I said earlier, we really, really would love to watch everybody in this program succeed.
Yeah, and he did have a question at the end. He says that even though he's ending most days green, his average losing day is far bigger than his average winning day.
Okay, that's that eat like a bird, poop like an elephant thing.
Yeah, so I think we went into detail on that one earlier.
Mm-hmm.
David would like to know, can you comment on the differences between market profile versus volume profile?
Okay, that's really a very good question. The volume profile is price over volume, of course. The TPO profile is price over time. They do end up looking pretty similar a lot of the times. If you look at this one, I mean, we're looking at two very similar things. I don't know exactly where the TPO point of control is, of course, the widest point closest to the center, and it's 95.5. I don't have the volume point of control pointed out here. When the market is open, it does point it out, so I'm not sure. Well, here, let's see. Volume 87.8. 92. This is the volume profile. This is the price where that traded most of any of the prices. They're usually pretty close. So you got the TPO, you got the TPO point of control, the volume point of control, but they both kind of point out areas where the market hasn't. This points out where the market traded the least. This points out where the market has spent the least time. The market moved through here 3 times, but it didn't spend a lot of time trading there, which is what the volume profile points out. It spent some time here, but didn't trade much here. And of course, on the ends, you're going to end up with the least volume. But obviously, this is where the market spent the most time and most volume racked up, although I'm not really impressed with the amount of volume compared to the time it spent here that it found here. I do look at volume profile, but it's the TPO profile that I've learned and has been the most useful tool for me, and I'm sure that there are things about volume profile that I do not know, and for that I apologize. Perhaps we can learn them together.
Okay, Vance would like to know, can someone from Canada or international student enter your program?
Absolutely. We have people in the program from all over the world. We have a live trader from South Africa. We have a live trader from India. What did I talk to last week? I talked to the UK. I talked to Ireland. We talked to people all over the world, and we have a number of people in the program that are from Canada. And some of my favorite musicians are from there.
Okay. David says, how is risk management calculated during Forex or futures? He's talking specifically, like he says he wants to have 1% max portfolio loss, and he wants to know about leverage. He says, is it different for your program, or you said leverage for individual markets?
Well, we have, I guess it would be in a simulated $50,000 account, you have a $1,000 a day loss limit. So it would take you, what is that, a 2%?
I think he might be asking like margins.
Oh, margins? Well, if you are a live trader with us, that's not something that you have to worry about, and we don't. For our live traders, we don't have a minimum performance requirement as far as profit is concerned. We know that many of the people that we are taking live are taking their live account for the first time. We want them to be patient. We don't want them rushing for any finish lines. If it takes them a while to get to the point where they're able to amp up their volume a little bit, or even that's okay with us. The important thing is that you are getting used to that live account, building confidence. You've already put together a trading plan that we have a copy of. We're going to help you remain accountable to that plan. And you know, at first, we really don't want to push you. You don't have to feel pushed. If you need days off, that's okay. You know, we're not really looking for any minimum requirement as far as performance is concerned from the live traders. We've seen enough guys, and you know how it is. Sometimes people, when they first get their live account, they freak out. It changes their thought process. We work very hard to try and get people comfortable before they get to that point, and you know, our live traders are doing well. They're, you know, holding their own at least, and some of them are really getting consistent profits, and it's going very well for them. And so we try not to push people in that respect.
Okay, Charles would like to know, do you recommend exercising discipline on a bad day to not take a trade where the practical risk is greater than the loss limit for the day?
Yes, if you are considering taking a trade where the logical stop price for that trade is beyond your loss limit, you can't afford to take that trade.
Mike would like to know, how do you adjust to volatility? Let's say that you make money when the VIX is below 20, but when the VIX is below 20, there's not that many opportunities.
VIX below 20, there's not that many opportunities. Yeah, there's opportunities, but you have to be realistic. That's one of the market state conditions that I look at, is I, you know, kind of look at what kind of volatility we are seeing in the market. I use the same setups, but my profit objectives are nowhere near what they will be when there's volatility in the market. My stops can be even a little bit closer, because I'm going to get validation, or I'm going to be proven wrong with much less space involved, with much less volatility, and I can tighten things up a little bit that way. When I'm hot on days like that, when there's a ranging market, I trade ranging markets pretty well. When volatility is low and we're in a ranging market, I'm pretty confident, and the way I amp up profits on those days is increase volume a little bit. Instead of taking one or two, I may put on 3, 4, and if it does go my way and I get some verification relatively quickly, I may add to it from that point, and then hit multiple targets on the way out. But I'm paying for the trade on the way.
Burke wants to know, what percentage of time should someone be in the market? It seems like most successful people are in the market the least amount of time.
Burke, glad to see you. You're probably absolutely right. I think that I spend a lot more time out of the market than I do in the market on most days. Certain days that might not be true, but I might be in one position for the better part of the day, not chopping through a whole bunch of stuff. Once I have a setup, especially in low volatility days, it might take all day for it to get to my profit objective, and that's the only way that I'm in the market all day. But I think you're right, especially when it comes to scalpers or intuitive traders. I think you really have to be careful with being in the market too much. You know, not taking a trade is a trade as well. Over trading is one of the biggest things that I think young traders do. People that just sit down with their first simulator, even if they have some market knowledge, they just they get click happy, and it rarely ever pans out.
Sharon would like to know, do you pay more attention to yesterday's value area or today's?
Early in the day, I'm definitely paying attention to the previous day's value area. There is a rule that we call the 80% rule that I'm sure most people are aware of. But what it is this is yesterday's value area. This is today's trade. If you if this market would have opened up outside of this day's value area, let's say it opened up here and balanced and traded down into the previous day's value area, and you have 2 half-hour bars close at 91.5 or lower, 80% of the time, and that's of course an estimation, I don't even know if it's that. Lately it seems like it's the 60% play. 80% of the time they say, I don't know who they are, but they say that if you have 2 half-hour bars closed below that level, 80% of the time by the end of that session, this market will trade and test to the other side of the previous day's value area. They never make it easy. They usually do things to try and rattle you out. Sometimes it'll happen so fast you never get a chance to get in. Sometimes you'll try and get in 3 times. They'll take you out, and then they'll finally do it. Sometimes if it happens late in the day, they'll get halfway through, and then they'll finish the move in the evening session. So rarely do they make it easy, but it does tend to work.
GM would like to know, what time frame do you use to trade the SPs?
99.9% of the time I'm looking at the half-hour chart. It's a half-hour candlestick, and then the profile that I look at is a half-hour, of course. You can change the time parameters on the profile, but the half-hour is the original and best in my opinion. I think the half-hour chart weeds out a lot of noise that is in the market because of algos, and I'm particularly interested in how the market acts in the last 3 minutes of each half-hour bar and the first 3 minutes of the next half-hour bar. I think that half-hour change like that provides some very good information.
Crude Trader says he's had some success in a few combines in the past. He has a decent trading plan and good risk reward, but the trouble is shutting himself down before hitting his loss limit. His good days are better than his bad days, but when he has a bad day, he keeps swinging until his loss limit has been hit. He justifies it to himself, saying that he's too competitive to throw in the towel, but he wants your advice.
Okay, I think I know who this is, and it is a core discipline. If you're a very, very competitive person, I think that's a good thing in trading. But you know, there's days that even Michael Jordan didn't have it. There's days Tiger Woods doesn't have it. There's days David Justice didn't have it. There's days that you just don't have it. And there's nothing wrong with admitting it. You don't have to admit it to anybody but yourself. And you might find that you'll start to feel good about it. When you know, if you've got $1,000 loss limit, you're just not feeling it, you're down $500 and you say, you know what, the heck with it, I'm going to stop because I just don't feel it. Maybe I'll go take a walk, maybe I'll go work out, maybe I'll go play golf for a couple hours, come back and see what the market looks like this afternoon. If you come back to it with clear eyes, it might make a difference. But sitting there and continuing to swing at the market, you know, you've kind of proven to yourself that it doesn't work, and you have a problem putting it away. But you know, this market swings back. Everybody's got a plan until you get punched in the nose.
Okay, Brian wants to know: do you or which market breadth tools do you use?
Market breadth. You're talking participation.
You know, tick, VIX, that kind of stuff.
Well, I was introduced to the ADX, which is average directional index. There's 3 lines in that. The black line indicates participation and probable type of participation. The higher that line goes, the higher the probability that you're looking at initiative action even inside a profile. It also gives you some sort of odds indicators. The DX plus and DX minus will give you kind of an indication of possible beginning of trend. So as the DX plus rises with a rising ADX, you're looking at good participation and the possible increase of probability that a upward trend could be beginning. could be beginning. But the black line is really the one that I look at most. It's got to be, it's got to be either rising or above 20, 25, something like that, for me to believe that the participation in the market is something that's providing good information.
Okay, I think we've answered this, but just in case, I'll ask it anyway. Fernando wants to know, what are you using as the opening range?
The opening range, I'm sitting on the trading floor, so I see what the pit opening range is, and it's usually very similar to the opening range that is shown in the profile here. But I think the electronic uses a time factor. It may be the first 30 seconds or the first minute of trade. In the pit, again, it is however long it takes for all the orders that were in the pit before the open that are due fills on the open to get filled. It's not a time thing, it is a price level thing. So all the prices that are traded by the filling brokers in order to fill those orders, that is the opening range. So I am in our chat room, I announced the opening range for the S&P, the NASDAQ, the Dow. I don't really have the information on the products that aren't traded on this floor as far as that's concerned, but if you do have a separate program for profile, it should provide you with that information.
Robert would like to know, do you have anything to help him with the trader's mindset? I don't know if he's talking about books or if you have any recommendations for him.
Well, the first 100 pages of Mind Over Markets. I think it is a wonderful explanation of how trading can work. He compares beginning to trade with learning an instrument. The first time you sit at the piano, you have to look at each note and then think about each note as you try and find each note on the keyboard. But as time goes on, and you practice and you look at it more and more, you become smoother and faster, and pretty soon you're able to look at a piece and begin to play it with feeling. And that is kind of what it is like trying to learn how to trade. It poses a particular problem for pit traders that are trying to move the screen. We have to unlearn a whole bunch of stuff before we can actually begin to accept what we need to learn to do this. But the first 100 pages of that book were a lifesaver for me. I'm sure if my friend didn't grab me and hand me that book and tell me to do that, I would probably be doing something else for a living at this point. So it was a very important book for me to understand what a trader's mindset should be and how the auction process really looks. And it is a theory. Some people don't particularly like or believe in market profile, but the first that next day when I brought that book back to him and I went and bought my own copy, I was pretty much able to stop losing money. I mean, I knew what I had to do in order to get better trade locations, in order to manage the risk a little bit better, and to know when I was wrong. Half the battle is knowing you're not right.
All right. Tony wants to know, how much does it cost to join TopStepTrader?
Well, we have a one-week training that's free that'll help you get used to the platform and get you into the chat room and into Trading 101 if it's something you choose to do. We also, because of our partnership here with Big Mike's, you can also get 2 more weeks of the training for free by entering the scout code Big Mike on our website. So you basically can get 3 weeks of free training on our website just to even check it out. Should you decide to join a combine, they're priced, and these are deposits. If you can perform to certain scout criteria, certain good trading habits that you're pointing out, and some profit objectives, the deposit can be fully refunded to you, or you can use it to roll into another combine until you get to a point where you've achieved the profit objective and or scouting criteria to get a live account. So the deposits, I think, go from anywhere from $120 to $300 depending on which combine you go into. These deposits are not how this company is trying to find success. These deposits are required by the equity partners to ensure that we have serious participants and that they have some skin in the game. When I first put a badge on and jumped into the trading pit, I would have been more than happy to pay anything to not lose the money that I was losing. So it is available to anybody, and if you go to the website, it's pretty self-explanatory, and you can set up a call with me if it's something that you would like to talk about.
Okay. I'm going to throw one of my questions in now. Early on in the presentation, you had mentioned day session versus night session.
Okay.
There was a study done, not too long ago. I'm sure this is one of many, many studies. It basically says, the premise of the study basically says, if you initiate a new position at the open and you hold it until the close and you sell at the close, versus buying at the close and then holding overnight and selling at the open, there's a huge difference, a significant difference, that the overnight session significantly outperforms the day session in that way. Do you have any comment on that? I'm just curious.
I haven't seen that, and it's something that I should definitely look into. Like we talked about earlier, this is a continuous learning process, and my theory that the best information that is coming out of these markets is during the day session could be antiquated.
Yeah, I mean, I don't know for sure that it is. I don't think it goes against that theory. I think that my perception was more along the lines of the average American's 401k plan, is from close to close, right?
Right.
And a lot of people, a lot of volatility or movement at price, volume, of course, but price is happening overnight.
Right. Yeah, and that is true. It does move around.
Fernando says, I think we've already answered that. Joe says he's having trouble determining a good risk-reward parameter. He's pretty good at picking market direction, but he's stopped out by 1 or 2 ticks, and he's having issues setting up a workable risk-reward scenario. He wants to know what I'm having trouble reading this. Is risk a function of the size of your account?
Well, yeah, it can be. That's entirely up to you. I mean, if you build a plan that risks a certain percentage of your account per trade, then it's definitely related to the size of your account. And of course, if you have $5,000 in an account, you shouldn't be swinging 20 lots. What I would suggest, Joe, is if you are getting stopped out by 1 or 2 ticks, you've got something going on, your risk reward. You got to figure out how right you are. Over time, what's your win percentage? Are you right 40% of the time? Are you right 60% of the time? And over time, a 1-week sampling of this isn't going to give you a real number. If you are working on a sim, if you're trading a live account, you need to keep track of how many winners you're having, how many losers you're having. Many trading front ends will give you that statistic in a trade report. If you are right 50% of the time, then you're going to have to be better than a 1-to-1 risk-reward ratio. If you're right half the time and you lose the same as you do on your winners, you're going to bleed the account over time just in commissions alone. Nobody is, of course, that steady, but that's what that indicates. If you're right 60% of the time and you've got a 1.5-to-1 or a 2-to-1 risk-reward ratio, you're a darn good trader, and if you can keep that up, you should be adding volume. But again, if you are trading too big, if your initial position is the reason that your stops are as tight as they are and you keep getting stopped out by 2 stops, try trading smaller, putting your stops a little bit further away to give the trade a little bit more room to breathe, or work on trade location a little bit. I wish I had the answer for everybody, but it is so difficult, Joe, and you're dealing with problems that every trader is dealing with. And again, I think the most viable suggestion I can for you, if you're getting in with too many on, cut back on your size, give this trade a little bit more room to breathe, and see if you can't end up turning things around that way. And of course, always work on that risk reward. Try and get that 2-to-1.
Okay. From what I've seen personally, I want to add my 2 cents. From what I've seen personally, I see a lot of people setting stops based on risk tolerance, the pain thresholds, and the market doesn't give a hoot about that. So I think that it might be a good idea to trade smaller if you can, right? But if you're already down to 1 lots and you still can't afford that with a proper stop, You might consider, like if you're trading the full-size euro, you might consider trading the micros through CME-FX. I mean, you can even go down to 10 cents a pip on spot forex. But the point is that you could still trade the same full-size chart, but your DOM is on the micro. Cut your risk by 10, factor of 10, and that'll allow you to properly size the stop. If the problem is that you're setting a stop so small because of that pain threshold. I see people that if I say that this trade that I've got on's got a 30 tick stop, their jaw drops like, oh my God, 30 ticks. And, they only are willing to risk 6 ticks. But yet I'll see them take 5 trades in a row. They'll be short, get stopped. Go short again, get stopped. And go short again, get stopped. I'm like, it would have been better just to set a wider stop based on, price action than to do all that. But anyway.
I completely agree with the idea that you can't place those stops due to financial decisions. You got to trade market information. If it's a pain threshold thing, you're thinking about the wrong thing for placing the stops there. And I love that. Yeah, I'm going to risk 6 ticks 5 times, and I'm going to lose the same 30 ticks you are.
Yeah, or worse because
you have a chance of staying in.
Right. Yeah, it's worse because you paid all those commissions too. So.
Right.
Okay, we still have a bunch of questions. I figure we'll go like 10, 15 more minutes, and then we'll have to stop.
Okay.
Jay Preston says, do you ever try to determine the market state for longer period of time frames like daily, weekly, monthly? And then he wants to know if you care if the big picture is trending or in congestion, or if it's entering or exiting a range, etc.
Johnny, I do look at that stuff. I have a book that has a form that came out of the book, Mind Over Markets. It is a directional performance log. I put it in there. I put the profile. I tape it to the page in front of it, and then it has information like rotation factor, volume, whether volume rose that day or fell that day, my opinions on what happened that day, and it helps me keep track of directional conviction that way. It also has me log whether the value area is above or below or overlapping from either direction the previous day's value area, and it helps me kind of keep an eye on what I believe a longer term market state is. I don't trade, I don't hold positions for that long, but I believe it is important for you to try and recognize longer term trends because it's going to help you recognize when the market may be going into a longer term oscillation or a longer term continuation of that trend, or even more importantly a reversal of that trend, because as the market trends in that direction, even over days or weeks, if it begins to lose volume in that direction, you're looking at a market that may be ending that trend at some point in the unknowable future, but it's good information to have. If you're in an uptrend, and you've been buying dips very aggressively, you may want to back off a little bit because you're looking at a market that may be running out of legs. If volume continues to increase, that rally could continue until 2020. Who knows?
Right. Okay, I want to throw in another question of my own. All in, all out versus scaling in, scaling out. What are your thoughts?
This has been a debate in our program. I'm not an all-in, all-out kind of guy, but if I'm trading with good trade location, and the market goes against me, I'm looking at verification that I'm wrong. I'm not adding to that position. If it hits my stop and turns around and goes my way, well, then my stop was too tight. But I'm not a fan of adding to losing positions. So if I'm scaling in an area, I would prefer to wait till the market aligns to good trade location for me to enter the first trade. And if price action and participation are giving me verification, I'll add to that position on the winning side relatively quickly. but I'm not going to, I don't add to trades that are currently against me. And as far as scaling out is concerned, I'm fine with that, because if it's part of your trading plan and something you're executing consistently and you're consistently having it happen for you, then you've got pretty good market state identification, because your profit targets are reasonable, and that's having it going on. If you ask me, if you are able to put a trade on, recognize it's right, add to it as you are supposed to, and then scale out of it, that's a beautiful trade to me. Those are happy days. I whistle my way to the train on those days.
Okay, Javier wants to know, how important is yesterday's profile?
Well, yesterday's profile is important. The most important part of it is the value area and the point of control from the previous day. If you open outside that value area, let's say above it, the high of the previous day's value is going to act as support. That is an area of acceptance from the previous day that was rejected in the current day. If the market trades down there, it may just be fishing to see what kind of volume it's got, and it will act as an area of support. If today's market does enter that value area and close 2 half-hour bars within that value area, the 80% rule comes into effect, and 80% of the time the market will trade to the other side of the previous day's value area and look for support there. If it doesn't find support there, then you're looking at a market that might be in more trouble than just going through the previous day's value area. If you open within the previous day's value area, you're looking at what looks like could be an inside day, which is the way today started out in comparison to yesterday's value area. We opened within value. It very well could have been an inside day. If you look at the first 3 half hours, we never left yesterday's range. We opened within yesterday's value. We kind of tested both sides of it, and we did end up leaving and tipping our initial balance from today to the upside, but that high of yesterday's value was acting a little bit like resistance, because the market did try to trade up there and through 3 times before it actually did. Within about 4 or 5 ticks, it looks like. I don't know. I took my glasses off, so it's kind of hard for me to see, but the previous day's value area can be very important information, as well as the previous day's point of control. If you are looking at the screen, here's yesterday's point of control. That's the TPO point of control. 3 ticks off the low of today's low. Pretty good. I'd venture to say it's not coincidence.
Sure. And those 3 ticks could just as well be to trap shorts too, or run some stops. Okay.
Absolutely.
Marco wants to confirm that you can use NinjaTrader in the TopStepTrader program.
No, we don't have NinjaTrader in the TopStepTrader program. We have been talking to them. We have not been able to come to an agreement with them yet, but it is possibly in the pipeline. I don't have a time frame for it yet, though.
But I mean, just so I understand, you could use Ninja Charts and then just
you can use their charts. You just can't execute through it.
Right, gotcha. Don wants to know if you can use Sierra Chart.
Yes.
Okay. Keith wants to know if you have a strong conviction in an entry point, which I guess you should have on most trades. Do you favor an all? We just talked about this. Do you favor an all-in strategy and scale out, or scaling into the position when it moves in your favor? He has difficulty scaling in, so he's trying to figure out what fits his personality.
Yeah. Scaling in is hard, especially if you have a shorter time frame. I guess it would be kind of a personal preference. I don't trade huge. I don't trade big. If I put 5 on in one lump sum, it's something that I'm like, holy cow, I gotta have this. And I've probably got a pretty good positive P&L for the day already. I will, however, add to trades till I get to that point, and then hopefully hit my profit objective. But I'm always protecting profits with stops. Do I prefer an all-in? If you got a great signal, if this is something you really believe in, first thing I would consider is how many other people are looking at that position, going, holy cow, I got to take this, because the more people that do, the less odds that it's going to work. You're going to get your activity sensing algos, let you guys pile it up. They're going to run it to your stop, and then they're going to turn it around and run it your way. They do have the ability to kind of do that in small ways, so that, you know, when something looks that good to me, I really fear the whole lemming trade thing. But if it's something that, you know, that it's your little secret, then go for it.
Yeah, and I'll add my 2 cents. And every time, I think you mentioned this too, but every time we talk about this on the forum, you know, there's always a set of traders that are real quick to say that scaling in or out is mathematically inferior to all in, all out. And that may be. I've never been that good at math. But the reason that I scale out is it's what works for me, right? I get that sense of, if I didn't scale out and, you know, I was flat and then the market ran another 10 points, I don't have a good feeling about that. It works better for me to have multiple targets, you know, staggered throughout the market, and I just feel a better sense of accomplishment. So that's what works for me. You know, mathematically inferior or whatever, that's not as important to me as what actually makes me feel good about the trade.
I can agree with that totally. You know, if I have multiples on and I have multiple targets, you know, I'll have, you know, let's say I have 4 on, I'll have targets for 3 of them, and then the last one I may just put a trailing stop in and end up with a trade that I would never even realize if I can get a run around like that. That to me is mathematically superior, because all of a sudden, you know, instead of I've taken 2 handles on one, 3 handles on one, 4 handles on one, now I got 10 handles in the last one. That makes me feel really good. So I totally agree with you. There's a lot of mental capital in that as well.
Yeah, I used to do that with oil, which I don't trade anymore, but oil is perfect for that scenario, because you never know when it's going to just bust out and run 100 ticks in the blink of an eye. So having that runner is great. Okay, Joe says the Combine has changed his whole trading. He's had his first profitable week after joining. Okay, that's no question.
Congratulations, Joe.
Yeah. Michael wants to know, how does he sign up?
You can just go to the website. That's TopStepTrader. I don't want to, you know, I'll say the word .com. But you can go to where it says programs and then go to training, and there's 2 different trainings that are available there. There's a nice goofy picture of me that you can laugh at. You can sign up for the 1 week, or if you sign up for the 2 week, and when it prompts you for the prospect code, put Big Mike, and it will get you that 2 week training at no cost.
Okay. I'll just try to pick a couple more questions here. Brad wants to know, what's the average time frame between entering the Combine and trading a funded account?
That's a really tough question. There's a lot of people in the program. Some have been trading in the Combine for months. They've actually achieved goals, but didn't feel as though mentally or emotionally they were ready for the live account. I really don't have an answer for the average. We've had one trader that was so successful in his first Combine that the equity partners grabbed him right away and said, get him on the live account. You know, and we've had people that have probably been in the Combine and rolling over into more Combines with their original deposit for 8-10 months. So it's really a really personal journey.
And let me ask, I'm curious for myself, do you guys furnish any trade statistics as part of the program, or is it up to the trader to keep all those on his own? Like, you know, MAE, MFE, expectancy, win-loss ratio, all that kind of stuff.
We do provide. We have profiles that they can fill out with their personal information. Those profiles do have a trade report that has it has win-loss ratios. It has time duration. You know, it tells you what your average time that you're staying in winning trades, losing trades. It has simple trade statistics, like, you know, how many trades you took that day, how many shorts, how many longs. It's actually pretty decent. There are some other statistics that we look at outside of of those profiles, and that the equity partners do see. They will also provide them with an online journal that is private to them. They can use that journal if they want to. Part of their trade report is they can actually enter in a market state for each day at the end of the day. If they were in a trending market, they can enter that into the trade report so they can see the date, what kind of day it was, and they can begin to notice what their strengths might be as far as day types and what their weaknesses might be. And we're in a constant effort to try and improve what we are providing for them as well. So
Okay.
I may have missed a couple of the statistics that are on there, but I'm about ready for a nap.
Yeah, I'm going to say there should be 3 quick questions and we're done. Here's the first one. Matt wants to know, do you have to trade ES or can you trade other instruments?
No, you can trade many other instruments. The most popular instruments in the program are, of course, the crude oil, the E-mini S&P, and the Euro FX. But we do have people trading NASDAQ, Russell, gold. There are some restrictions on times that you can trade gold. I'm trying to think of some of the other products, but pretty much we have people trading grains. We have people trading 30-year bonds in the combine. I'm trying to think of everything else, but Brent crude.
So most of the futures, it sounds like.
Yeah, it's really all the CME group futures, but only the more liquid contracts. It really has to be a contract that trades more than 50,000 every day.
Okay.
Otherwise, you can get fills that aren't really indicative of a live market.
Leonardo wants to know, do you recommend using an ATR in a ranging market?
You know what, I forgot to mention, I shortened up the time frame for the ATR. So it moves a little bit faster than, because I'm looking at a half-hour chart. If I were to look at a half-hour ATR, I'd fall asleep. And sometimes, yeah, I do, because it can give you some indication or clue as to what type of activity is coming in at that point. If you're getting initiative activity at the end of a range, watching the ATR and watching what side of the bid and offer is being traded most, keeping an eye on the bids and offers as they come in. If you get an ICE order, you got to be able to spot that. There's so many different things, but yeah, I try and keep one eye on it. It's a new tool for me, but I'm trying to see if I can learn how to use it effectively.
Okay, and we're going to make this the last question. Ben would like to know, based on your experiences from the floor, why do our stops always get hit if they're hidden close behind the support resistance area? Is this organized over lunch or what?
No, actually, it's probably not floor traders. So much of what goes on in the floor traders in the floor is an arbitrage now between the S&P and the E-mini. You've got very few pit traders who are actually trying to move markets around to try and fish out stops like that. You're looking at more of some predatory algos that sense order flow from smaller traders. They see the lemming trades that people are making, and you might be getting trapped in that. What I usually suggest when people are running into that, especially in night trade, is to try and experiment. Not, of course, don't experiment with your live account, but if you're trading a simulator, the next time you get one of those great indicators that you're talking about, and they seem to always fish out your stop and then go your way, try initiating the trade where you were going to put your stop a couple of times. You're probably going to miss some trades, but at least you're going to avoid that whole lemming thing. Try and beat them at their own game. If you see this great spot, but you think a lot of other people are looking at it, try and put your initiating order where your stop was going to be, because then you're kind of beating the algos at their own game.
Right. You got to do the opposite of the crowd. Okay, John, absolutely terrific webinar. Really appreciate it. Appreciate you staying on here for 2 hours and answering a million and one questions.
It's been my pleasure.
Do we have any contact info for anybody that has questions that weren't answered, or should they just go to the website?
Well, you can go to the website. I believe there's a thing on there that says schedule a scout call. If you go on there, schedule a scout call, you'll end up probably talking to me.
Okay, perfect. All right, guys. So once again, thank you, John, very much. And thanks for everyone that was here today. And I'll post the recording on the forum sometime tomorrow.
Well, one last thing, a secret word for the TST people, Sweet Melissa.
Yeah, you'd mentioned that before. I guess that's something going on.
Did I say that already?
Yeah, you did at the top.
Okay.
All right. All right. So we'll definitely have you back, John. I'm sure that people would like to have you back sometime in the next couple months. I look forward to it.
I will too. Thank you very much.
All right. Have a good one. Bye.
You too.